Something strange is happening with XRP, and it is breaking every rule retail investors think they understand about markets. CME Group just launched XRP futures contracts. XRP exchange-traded funds are approaching $1 billion in cumulative inflows, with over $1.1 billion in total assets. 30 consecutive days of institutional money flowing in, not a single day of outflows. Just days ago, Ripple secured conditional approval for a national banking license from the Office of the Comptroller of the Currency. Headlines everywhere are screaming bullish. And yet, the price chart is dead, range-bound. Boring. This is not what people expect markets to do. When institutions buy, prices are supposed to explode, right? That is the narrative we have been sold, but XRP is teaching us a lesson that most retail traders never learn. Institutional money does not move like retail money, and the answer reveals something most traders completely miss. Let us start with the biggest misconception. ETF inflows do not automatically mean price goes up. This is what retail expects, but it is not how ETFs actually work. When you buy XRP on Coinbase, you are hitting the open market. Your order creates instant buying pressure. The price responds immediately. It is direct, visible, and transparent. ETFs operate differently. When institutions allocate capital into an XRP ETF, that money does not necessarily hit exchanges right away. The ETF issuer can create new shares through what is called an authorized participant. These authorized participants can source XRP from over-the-counter desks. They can source from existing inventory, or through block trades that never touch the public order book. Think of it like this. Retail buying is like shopping at a busy farmer's market. Everyone sees the transaction. Prices adjust in real time based on visible demand. Institutional ETF buying is like a grocery chain negotiating directly with farms. The transaction happens behind closed doors. The public market does not see it until much later, if at all. This is why XRP ETFs can absorb nearly $1 billion in 30 days without the chart exploding. The liquidity is being pulled quietly from sources that do not create immediate price pressure. It is not manipulation. It is just how institutional infrastructure works. And most retail traders do not understand this distinction. Now let us talk about why XRP specifically behaves this way. XRP is not a small cap altcoin. It has deep global liquidity across dozens of exchanges and over-the-counter desks. It has a circulating supply of over 60 billion tokens. This is not like buying a micro-cap token with $10 million in daily volume. Large circulating supply means more tokens available to trade. Deep liquidity means big orders can be filled without massive slippage. Over-the-counter desks provide private markets where institutions can buy large blocks without moving the public price. All of this creates an environment where significant capital can enter without creating the explosive price moves retail expects. Here is the key insight. Liquidity can mute price action in the short term, but it does not eliminate price discovery. It delays it. Think of it like water building up behind a dam. The pressure increases gradually, invisible to most observers. Then something shifts. The structure changes, and suddenly, all that accumulated pressure releases at once. This is the phase XRP is in right now. Accumulation. Institutions are building positions through channels that do not create immediate volatility. And retail is getting bored watching paint dry, which historically is exactly when the biggest moves begin. Let us zoom out and talk about ETF life cycles. Because this is critically important for understanding where we are right now. ETFs have phases. The first phase is infrastructure. Issuers set up custody. Authorized participants establish relationships. Institutions allocate initial capital. This phase is boring. It is plumbing. It is back office operations. There are no fireworks. The chart does not move much. Retail loses interest. The second phase is momentum. Allocation turns into conviction. Inflows accelerate. More institutions pile in. The narrative spreads. Price starts responding to the accumulated demand that was building quietly during phase 1. This is where reflexivity kicks in. Rising prices attract more capital, which drives prices higher, which attracts even more capital. XRP ETFs launched in mid-November. We are 1 month in. We are still in phase 1, the infrastructure phase, the setup phase, the boring phase. And here is what is remarkable. Even in this early stage, XRP ETFs are already outperforming. They hit $1 billion faster than any other crypto ETF except Bitcoin. They've had 30 straight days of inflows with 0 outflow days. This is not weakness. This is methodical institutional accumulation. The narrative that XRP should have pumped by now misunderstands how institutions operate. They do not rush, they do not FOMO. They build positions over weeks and months, not days. The first phase builds plumbing, not fireworks. And we are still laying that plumbing. Now let us talk about Ripple's banking charter, because this is where most people completely miss the point. On December 12th, Ripple received conditional approval from the OCC to operate a national trust bank. The headlines called it bullish. Retail expected the price to pump. It did not, and people got confused. But here is what a banking charter actually does. It does not move price directly. It changes who can participate in the ecosystem. A national trust bank charter allows Ripple to provide custody, settlement, and compliance services under federal oversight. It positions Ripple's stablecoin, RLUSD, as a federally supervised asset. It makes institutions comfortable. Institutions do not buy based on headlines. They buy based on infrastructure readiness. Can they custody the asset safely? Is there regulatory clarity? Are there compliant on-ramps? Is counterparty risk minimized? These are the questions institutions ask, and the banking charter checks those boxes. This is a systems-level change, not a price catalyst. It does not create immediate buying pressure. You see the ETF inflows, you see the banking charter, and you are thinking, why is the price not moving? Here's the reality. Retail and institutions operate on completely different timelines and with completely different priorities. Retail watches candles. Institutions watch liquidity depth, counterparty risk, regulatory frameworks, and infrastructure readiness. Retail expects instant reactions. Institutions plan in quarters and years. Retail gets excited by announcements. Institutions wait for implementation. This creates a massive perception gap. Retail sees bullish news and expects immediate price action. When it does not happen, retail assumes the news did not matter or the asset is broken. But institutions see the same news as a green light to start building infrastructure for future capital deployment. The reaction is delayed by design. This is not unique to XRP. This is how institutional adoption works across all assets. The confusion comes from expecting institutional money to behave like retail money. It does not. It never has. And it never will. And speaking of structural changes, let us talk about what just happened. CME Group, the world's largest derivatives marketplace, just launched spot-quoted XRP futures. This is significant. CME already offers Bitcoin and Ethereum futures. Since launching those products in June, they have traded over 1.3 million contracts. With December volumes hitting record levels, now they are adding XRP and Solana to that lineup. These are not massive institutional contracts. CME specifically designed these as their smallest crypto contracts yet. They are targeting everyday traders and active participants. Why does this matter? Futures markets provide hedging tools. When more participants can hedge cleanly, it increases two-way flow at major price levels. This can initially dampen volatility, but it also improves price discovery and deepens institutional participation over time. It is another piece of infrastructure being put in place, not a price catalyst today, but a structural foundation for larger participation tomorrow. So what actually changes the structure? What turns this quiet accumulation phase into visible price movement? Here is where things get interesting. First, ETF demand starts hitting exchanges directly instead of being absorbed by OTC desks. This happens when OTC liquidity dries up, or when inflows accelerate beyond what private markets can handle. We are at $991 million in cumulative ETF inflows as of today. That pressure is building. Second, sell-side liquidity decreases. Right now, there is plenty of XRP available at current prices. When that supply gets absorbed and sellers move their ask prices higher, that is when you see sustained upward movement. Third, volume expansion. Trading volume reflects conviction. When volume starts expanding on up days and contracting on down days, that is a signal the market structure is shifting from distribution to accumulation. None of these are price predictions. They are structural conditions, and here's the important part. Price moves last, structure moves first. By the time retail sees the price pumping and starts chasing, the structural shift already happened, weeks or months earlier. Institutions were buying when everyone else was bored. Now let us talk about risk, because staying credible means being honest about both sides. ETF demand could stall. Right now we are seeing consistent inflows, but that could change. Macro conditions could deteriorate. Risk appetite could shift. Competing narratives could pull capital elsewhere. Liquidity could remain heavy. Just because institutions are accumulating does not guarantee explosive upside. If sell-side liquidity stays abundant, price could remain range-bound for longer than anyone expects. And let us be honest, XRP could stay boring for months, maybe longer. The structural setup looks interesting. But setups do not have timelines. Markets move when they are ready, not when we want them to. This is not fear, uncertainty, or doubt. This is reality. Understanding the structure does not guarantee profits. It just helps you understand what you are actually looking at. So here is where we are. The institutions are already positioned. I am not telling you XRP is going to pump tomorrow. I am not giving you a price target. I am showing you the structural dynamics at play and helping you understand why the market is behaving the way it is, because here's the truth. The biggest moves usually happen after everyone gets bored. When retail loses interest, when the headlines stop, when volume dries up, and nobody is paying attention anymore. That is often when the structure has fully shifted, and the real move begins. If you found this breakdown valuable, hit that like button and subscribe for more educational crypto content. Drop a comment and let me know. Are you watching XRP right now? Or have you moved on to other narratives? Thanks for watching. I will see you in the next one.